valuation of residual assets, the institution's overall cash flow might be dependent on the residual cash flows from the performance of the underlying assets, meaning the ABSs, the credit cards, mortgage, autos. If the performance of the underlying assets is worse than projected, the institution's overall cash flow will be less than anticipated. Residual assets retained by the issuing institution are typically illiquid assets for which there is no active market. Additionally, the assets are not acceptable collateral to pledge for borrowing. An issuer's market reputation can affect its ability to securitize assets. If the institution's reputation is damaged, issuers might not be able to economically securitize assets and generate cash from future sales of loans to the trust. This is why I said, hey, I found your investors, their representative. I'm going to send them letters. The last thing they ever want you to do is find out who their investors are. Because if you put a little battery in their back, regardless if, even if it's true or not, they're damn sure the investors are going to call the people and be like, yo, we got a letter from such and such. What's going on? Saying y'all didn't legally acquire these assets and they got a whole rundown list and all that. And they got court cases confirmed. Hold on. The bank is going to make a line to you. Hey, what's going on? Hold on. No. What do you? No default. No, that wasn't a notice of default. No, you're good. No, that was a mistake on the computer. They sent me 4 letters. Oh, there's already a foreclosure file. Oh no, we get that taken care of. No. As a matter of fact, there must have been a mess up with the name. No, you're not on the default. As a matter of fact, what we're going to tell you is we're going to do a $250,000 loan forgiveness part of our program. Yeah. So listen, 250,000 off and just $1,000, a month, for the next 20 years. That's it. No, don't worry about that. Like a beeline to you. Oh, what do you mean? Foreclosure? No, we're not coming to foreclose. This is especially true for institutions that are relatively new to securitization markets. The time frame required, here we go. The time frame required to securitize loans held for sale may be considerable, especially if the institution has limited securitization experience or encounters unforeseen problems such as the Accrual County collection agency. Institutions that identify asset sales or securitizations as contingent liquidity sources, particularly institutions that rarely sell or securitize loans, benefits from periodically testing the operational procedures required to assess these funding sources. Market access testing helps ensure procedures work as anticipated and help gauge the time needed to generate funds. However, testing does not guarantee the funding source will be available or on satisfactory terms. A thorough understanding of applicable accounting. Yes, securitization uses the highly advanced accounting module. Yes, there's just no way around it. You have to understand advanced accounting to really grasp securitization, just because the words they use and and that's what we go over too from the highly advanced level. There's no other way to understand it. There's no other way to water it down for you.
I hate to interrupt, but this is a very important part of this class because it kind of highlights all of our claims in which they identify as a risk. And that's one of the things that I have invented with regards to these spaces is pursuing our claims that they identify as a risk. Understanding the comprehensive breakdown on how they transfer our assets into the securitization trust is the hallmark of our claims, because if it wasn't done legally, the transaction never took place, and that is our remedy.
Of accounting and regulatory rules is critical when securitizing assets. Accounting standards establish conditions to achieve sales treatment of financial assets. Remember, to achieve sale treatments. Why do they need to treat sales treatments? Because they don't want these transactions classified as secured borrowings, although that's what they are.
This is a very important thing that I teach my students to understand because it's all about the accounting and where our claims and remedy lies. And if we do not understand the requirements for them to legally obtain these assets, which are our cash flows from our monthly payments, then the transaction never took place. And when we file suit, that's how we obtain the recharacterization in our favor.
They want it on the paper to be a sale, because if it's not a sale, it all crumbles. And all those transfer assets must come back to the entity that's in the short position, the lender, and can be a.
Ladies and gentlemen, I hate to remove that last segment, but that's part of the services I offer. So I had to blank that part out. Sorry.
And guess what? The interest can be attacked and can accrue back to us.
This is not something I'm making up. This is actually from multiple court cases that I've read where the borrower was able to get all that back.
The standards influence the use of securitizations as a funding source because transactions that do not qualify for sales treatments require the selling institution to account for the transfer as a secured borrowing with a pledge of collateral.
This is every finance company, mortgage company, bank examiner's worst nightmare. When we approach them with that claim, they have no comeback and they have to acquiesce.
Told you, bam, bam, bam. That's the number one fear right there from the FDIC right here, y'all. It's the number one fear, even though all of it is this right here. Why do you think they needed to say it be that on the accounting side, be a sale?
But let's not get it confused. This is why we have to know advance accounting because they're going to account for it as a sale, even when it's not. And whether it was a sale or secured borrowing, that is a legal determination. This is why we have to bring them into court for the legal determination of the transaction. And this is why I say we must understand advanced accounting.
As such, management must account for and risk weight the transfer as financial assets as if the transfer had not occurred.
That is direct evidence of everything that I'm saying. This is from the FDIC. Remember, you just heard account for it as the transaction never occurred. This is why we take them to court to get the legal determination and a recharacterization of the transaction. Because once we recharacterize it as a secured borrowing, that puts us in the game for a recoupment, which I talked about in my right to set off class. So if you look at your contracts and your auto contracts, remember it tells you any person taking this property is subject to the claims and defenses, and any recovery thereunder is only limited to the amount you actually paid. Well, why do you think they're saying that? Because they know it's impossible for them to actually achieve sales accounting based on how the securitization game works. And if they did it the right way, they would be paying millions of dollars in taxes, in which it would defeat the point of them even securitizing it. So they are manipulating the balance sheets in the accounting because they know we don't understand advanced accounting. But when we understand, they have to redo it all.
Told you. Told you. It took my own words. The FDIC just mirrored my own words. What I say, it never took place. What do I always say? It never happened. The transaction never happened. Transaction never took place. Oh, there ain't no true sales. It never happened. It never took place. Now they're in a short position, liabilities, cash collateral, all that comes into play now. They just mirror my words. Remember, I said it's not real. It never happened. Now you got the FDIC confirming, just in case you ain't believing, as if it never occurred. Read that again. I'll say bar. As such, manager must account for and risk the transfer of financial assets as if the transfer had not occurred.
I teach this night in and night out in my Supreme Elite Team group. And this is from the FDIC, and this is directed at the bank examiners. These are where the high level accountants are at in the executive offices at the bank. So if you wonder why your notices of stuff to the bank fell on deaf ears, because you wasn't speaking their language. They don't understand the sovereign citizen language like you think they're supposed to do, just because you quote outdated statutes and regulations and acts of Congress that do not apply today. This is why I always say understanding is 98% of your remedy.
Accordingly, management should continue to report the transfer assets and financial statements with no change in the measurement of the transfer assets.
That last sentence was an accounting language. That's highly advanced accounting verbiage that they're using. So basically, when the transaction never really took place, the originator or your lender must bring those liabilities from the transaction back on their balance sheet. The reason why they never respond or they feel like they're trying to violate your rights is because they've already moved those assets off their books and they're just servicing it. So you're sending letters and letters to them. It doesn't mean nothing because they don't owe you a liability from the accounting standpoint. But once this recharacterization of the transaction takes place, their liabilities to you gets moved back to their books and they can now be attacked in certain court proceedings, which we go over in depth in my Supreme Elite Team group and in my mortgage justice class. So this is why a lot of people have failed. It's not because the system is just trying to keep them from asserting their rights. It's just that we lack understanding.
No change. One more time. As such, management must account and risk weight the transfer financial assets as if the transfer had not occurred.
That is something we can prove from their balance sheets and from a highly advanced accounting standpoint. And it's something which the courts have already ruled in claims that I talk about.
Bam! Right there is where we learn securitization. When you learn securitization, you learn the banks. When you learn the banks, that's how you win. When financial assets are securitized and accounted for as a sale, institutions often provide contractual credit enhancements.
Those credit enhancements are when they make you get extra insurance, all the terms on the contract that seems one-sided, all the proceeds and insurance proceeds that you have to give to them. That's all credit enhancements from the MBS or ABS note holders.
Which may involve over collateralization, retain subordinated interest, asset repurchase obligations, cash collateral accounts, spread accounts, or interest only cash collateral accounts. Remember the definition?
The definition I cited is a definition that nobody else in this space talks about. And to protect my members of my group and my paying customers, I had to block that definition out.
DIC rules and regulations require the issuing institution. Remember what I told you? That is the bank that's holding the account. That is the institution named to that? Why do you think that is? Why do you think that is? Requires the issuing institution to hold capital against the retained credit risk arising from these contractual enhancements interest and what we pay in interest. If they're paying 4% interest, but we're paying 12% interest, it's going to have the difference in there, which goes back to them. The problem with that is once we bring all those amounts as part of the, and that's where the set off occurs. There can also be a non-contractual support for ABS for risk-based capital purposes. Institutions deemed to be provided implicit recourse are generally required to hold capital against the entire outstanding amount of assets sold as though they remained on the books.
Apologize, got a little excited there, but as they remain on the books, that's the liability they owe to us. That is what people were actually trying to do. But they were sending in remittances, international business exchange, doing all this other stuff where the actual account, the actual assets that actually belongs to us is actually documented and is reported on their off-balance sheets. That is what you have to attack, not that other stuff.
That's the seats right there. That's it. Everything they saying, that's all ours. That's all ours. Risk-based capital. I would write that down.
It's from a private group that I had May 31st, 2025. If you are interested or like the information given, or if it's just totally new to you, just understand that this is the proper approach to take with these people. Will it be easy? No. Are they just going to roll over and play dead? No. Are they going to put up a fight? Yes, because our job is to get our rightful proceeds and assets and our equities returned to us. Their job is to keep them from us because they need those same assets and proceeds so they can continue their operations. It's a tug of war, but I'm going to tell you this. This is the legal standard. This is what must be proven. There is no separate system for people who think a different way. You can think whatever you want. You can believe whatever you want. But just because you believe in a course of action doesn't mean that course of action is legally recognized at law and in equity. And the problem that a lot of people have is just because they believe a certain course of action is true, that it's true. And I tend to see the world and see this stuff for what it is rather than for what I want it to be or what it should be. Court cases, even IRS procedures, FDIC, the accounting standards have all confirmed what I mentioned in this class. And it doesn't matter if the vehicle was already repossessed, the home was already foreclosed, doesn't matter if you don't have it anymore. These are still rights, these are still assets, these are still proceeds that remain on their books, and they must report it to the FDIC, the Treasury, and all other regulatory agencies. If you are interested in any class that I offer, my Supreme Elite Team Group, anything, if you are interested, please reach out to me at Thomas Legacy, ThomasLegacy 603 at gmail.com. This is what you need to know and understand. Yes, it's confusing because this is highly advanced accounting, highly advanced securities law, and tax regulations are complex within themselves. It is unrealistic to think that you're going to get all this down pat in a short time. Regardless if you have outside circumstances going on, regardless if you really need it done to save property or whatever, it is what it is. So if you are interested in understanding, or if you need assistance, reach out to the email. Thank you for watching and subscribe for more videos.